Welcome to today's webinar on agricultural credit conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Joe will be entertaining questions at the end of this presentation, so if you have a question, please type it in the chat box on Zoom. We'd also love to get your feedback at the end of this presentation, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Joe.
All right, thank you, Haley, and thank you to everybody for joining us on this Monday morning as we get a quick look into the state of agriculture in our region heading into the height of the growing season. I'll kick things off with a little bit of introduction. I just get right to the point here, which is this spring's quarterly agricultural credit conditions survey was rather negative. You can find the results from that on our website at minneapolisfed.org, and Haley's going to post a link in the chat. There were this was not entirely surprising, and I'll get into some more details about what exactly we're seeing as we go along here. One thing that I want to get out of the way right up front, though, is our standard disclaimer that my views are my own, and I'm speaking for myself and not necessarily those views of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So keep that in mind, particularly when we get into kind of the more sort of, analytical, forward-looking part. But I'll try and keep things pretty factually based and just kind of walk through the results of the survey and what we saw in the survey for this first quarter. So I'll give a little bit of a macro look at the agriculture sector in the 9th District, and in particular, just sort of how large of a share it is of our economy. We all know that it's our states in the north central United States are a pretty heavily agricultural region, and it has a pretty important role in our economy. And then I'll get into the results of the credit survey itself after describing a little bit of detail about what exactly we're measuring and who we're surveying when we do this survey, and then get into the survey results themselves. And like I said, so as not to keep you in suspense, the big noteworthy thing is a very strong majority of the survey respondents told us that farm incomes decreased in the first quarter of this year. Some other indicators showing some sort of weakening financial condition among farms. Like I said, not entirely surprising, and I'll get into some of the reasons for that. One thing to point out is we still saw some continued increase in farmland values across our region as well. I'll break that out a little bit. And our forward-looking indicators, just the kind of forecast questions we ask of our survey respondents, were fairly pessimistic as well. But I want to point out, I mean, it is a near-term outlook for the region. Not as much to say about the long-term outlook. So that's kind of a quick overview of where I'm going. Just a quick refresher that when I talk about the region or the district, those are terms that I'm going to use probably interchangeably. I'm referring to the Minneapolis Fed's district, the 9th Federal Reserve District. And you see those states that we represent on the map here. We have states of Minnesota, North Dakota, South Dakota, and Montana, and then we have portions of Wisconsin, the Upper Peninsula of Michigan. For the purposes of this survey, we don't really get into much detail about the Upper Peninsula of Michigan because unlike the entirety of the state of Michigan, the Upper Peninsula does not have a lot of commercial agriculture in it, not a lot of large-scale agriculture. It's certainly not compared to the other states to the west of the Upper Peninsula in our region. So we're really keeping focused on the states from Wisconsin to the west. One quick thing, so for those of you who are interested in the economy of our region and want to know more about what we're hearing from businesses and where we see things heading, my colleague Ron Wirtz is going to be doing another webinar like this one in a little over a week, giving an overview of recent results from a survey of the construction sector. He's done a number of these. He does these on a regular basis. So for those of you who are interested in the economy of our region, and particularly if you're interested in the outlook for construction, another sector that's very much in flux at the moment, given the state of the economy and the interest rate environment, it's a good time to get a reading on that sector as well. So Haley will be posting a link in the chat where you can register for that if you're interested in joining us for that. So with that, just kind of turn over to just a quick overview of the agriculture sector in our region, as I mentioned at the outset, you think about those states that we represent in the 9th Federal Reserve District. It's a heavily agricultural region. Now, interestingly, when we measure, the way we measure agriculture in terms of output, in terms of GDP statistics, it's actually a relatively small share of our economy. This is a bit misleading, though, because the way that we measure, the way that we do this sort of income accounting in our GDP statistics, we're only looking at the value added by a particular sector. So for this, in this case, we're talking about just production agriculture, basically. And then I'm including here, you can see it's also covers forestry, fishing, and hunting, but the largest share of this is going to be agriculture. So this is really just crop, livestock, and animal product production. So it doesn't take into account transportation, processing, services. A lot of the other industries that are part of, that either result from or support agriculture, are counted in other parts of the statistics. But the big point that I want you to take away from this is that in relative terms, agriculture is a much larger portion of our district's economy than the U.S. economy. So you can see it's just a little bit over 1% of U.S. output. And it's just under 4% of output for the states in the 9th Federal Reserve District. So, and that's again just measuring production agriculture, not all of the supporting industries. If you were to try and measure those as well, I'm certain it would be a much larger share of our economy. And you can see that as well if you look at kind of some of the states, like North Dakota in particular, its economy tends to move a little more closely with agriculture than the U.S. economy, which is sort of on a different business cycle than agriculture. And that's one of the things that makes this survey so interesting, is we get kind of a read on agriculture, which is in some ways on a different clock than the rest of the economy. Another quick indicator of sort of the size of the industry, this is just measuring the total amount of cash receipts from agricultural commodities, and I'm just tallying them up for the 9th District states. These are data that come from the USDA's Economic Research Service, and you can see that for the most recent year that we have available, which was 2022 at the state level, we were looking at nearly $80 billion worth of sales of agricultural commodities in our states. So certainly large business indeed, and you can kind of see how it's had its ups and downs, but it's been growing over the last 20 years. And that's in real terms. So these are in dollars that are adjusted for inflation. So you can see that even in inflation adjusted terms, the output of the agricultural sector has trended up over this time, even when it's had its down years. So that's just kind of a quick overview of the scale of the industry in our region. It's a large industry, and it certainly has a lot of cultural prominence in our region as well. So that's underscores why we do this survey. We do this survey on a quarterly basis. So just to kind of give you a quick, before we get into the results of the survey, just kind of a quick breakdown of what exactly it is that we're measuring here. This is a survey that we do of banks, not of agricultural producers, but they're banks in our region that are heavily concentrated in agriculture, that do a lot of agricultural lending as part of their portfolios. And we do this survey on a quarterly basis. We do these webinars to share the results on a less frequent basis. We think it's kind of most interesting to share the first quarter results, which we conduct in April, and then the fourth quarter results. So that's kind of for those paying attention at home, we're going to be doing another one of these webinars in November, right around harvest time. So really kind of right as we get into spring planting and harvest time is when it's, I think, most interesting to look at the results from the survey. But we do conduct it on a quarterly basis. We conduct it after a quarter is over. So the results I'll be sharing with you just now, we conducted in April, and it was backward looking on the first quarter. But we ask some forward looking indicating questions as well, and get kind of an outlook for the sector heading into planting, which is why I think this is one of the more interesting ones. So it is a survey of bankers, but you can think of them as being sort of experts in agriculture, because they do a lot of lending. They know their clients really well. They know their areas really well. A lot of these are smaller community banks. And they're pretty well versed in what's happening in the sector, because they spend a lot of time talking to these clients. In the April survey, we had a turnout of 60 bankers. Again, this is not a large sample. These are, these are banks that are spread across our region. 60 is actually a pretty good turnout compared to other recent quarters. So we had a pretty decent turnout response rate in the April survey. So that's just kind of an overview of what the survey is. Now to get into kind of some of the headline results of the survey, as I mentioned right at the outset, incomes are down. That is not surprising when you get into sort of the causes of that. Really what's going on is we're seeing most agricultural commodity prices have decreased, even some of them that have perked up a little bit recently, decreased on a year-over-year basis. And those operating costs are still higher, so they're still paying some of the kind of inflated prices for for fertilizer, for chemical, certainly for fuel as well. So the prices that they pay haven't come down in tandem with with agricultural commodity prices, and that's leading to some compression in margins. So not surprising that we're seeing a decrease in income, and this is consistent with what we heard from the USDA. Its most recent forecast for farm incomes for 2024, both on a net cash income basis and a net farm income basis, call for a very large decline. In fact, in nominal terms, the largest or one of the largest declines on record at a national level. We also ask about spending on equipment and buildings and land, so capital expenditures. Not surprisingly, that's also down. Household spending slightly up on balance, but the largest share of lenders telling us that hasn't changed. One good bit of news is we've seen some moderation in interest rates. They actually ticked down. Most of them did, at least slightly on a quarterly basis. They're still heavily elevated relative to a year ago and certainly relative to 2 years ago. And I'll show you what that looks like in a minute. Even given the higher interest rate picture, we've seen an increase in loan demand. And that's consistent with a tighter cash picture and a little bit of downward movement in loan repayment rates. But again, most lenders telling us that those haven't changed. And as I mentioned earlier, land values across our region are up from a year ago, and rents are up slightly as well. And we ask about all these things on a forward-looking basis as well. And so the outlook for the second quarter of this year is negative. So just to kind of give you an idea of where that breaks down, you can see that 70% of lenders across our region told us that farm incomes decreased. And this is on a year-over-year basis. So this is what happened in the first quarter, the first 3 months of 2024, relative to a year earlier. 70% of lenders told us that incomes decreased. That's a pretty large share for the survey, certainly compared to recent quarters. I'll show you what it looks like over time in a moment, but just to kind of share real quickly the results for household spending. You can see slightly about twice as many lenders told us that farm household spending. So this is purchases of vehicles and consumer items by farm households, not necessarily by the farm operations. Those are still up on balance. Capital spending, so you can think about that as an investment by farms, also down, not as large of a share of the respondents telling us that capital spending decreased, but certainly a majority, slight majority telling us that capital spending decreased. Again, maybe not surprising given the tighter cash picture and higher interest rates that farm operations would be paying to finance those purchases. So to kind of give you an idea of what this income picture looks like going over time, you can kind of see how this has trended down over the last year. So when I did this webinar a year ago, going over our first quarter results from 2023, incomes were still pretty strong, even though we'd seen some downward movement in prices at that time. The income picture was still coming in pretty strong. And since that time, we've seen a steady trend downward. So you can kind of see where the current quarter at the very end of this time series here stacks up relative to what we usually see. And it's certainly not the lowest we've ever seen in terms of this is a share of respondents telling us that income increased or was unchanged compared with a year earlier. It's not the lowest we've ever seen, but it's certainly in the lower the lower half of the distribution over time. And you can see that that's just sort of trended down steadily over the last year. So not as bad as it could be, but certainly not great, and a consistent downward movement in incomes over the last year. Getting into some of the kind of more financial indicators that are consistent with that, we've seen over the last year, even though incomes have trended down, loan demand hasn't really picked up because farmers were coming out of this period that you can see sort of since early in the pandemic. We had a period of pretty strong farm incomes, and that's of course withered away. But up until recently, the working capital or cash cushions that farmers had available to them were sufficient to not require them to take on a lot of additional debt to continue financing operations. That's changed in the past quarter. So on a year-over-year basis, more than half of lenders told us that the demand for loans by farms increased, and these are for operating machinery and other types of loans. And only 17% telling us that demand for farm loans decreased on a year-over-year basis. Repayment rates down on balance, so the rate at which borrowers are repaying their outstanding loans was down on balance, but you can see a sizable majority, more than 2/3, told us that there was no change, but a much larger share told us that repayment rates were down than up. And renewal activity pretty steady as well overall, but up on balance. So that means we're seeing more farmers with outstanding loans renewing those loans. And that activity has ticked up over base. We got some comment on the survey as well. Some lenders saying that renewal activity was good, which to a banker means they're seeing more renewal activity. So that's again kind of an indicator of sort of tighter financial picture that farms are facing. Turning to the outlook, you can see that that's actually not only negative, but more so than what we saw over the past quarter. So 70% of lenders told us that farm incomes decreased on a year-over-year basis in the first quarter. Fully 75% expected to decrease in the second quarter on a year-over-year basis. So through 3/4 of lenders expecting decreased revenues. It's important to point out that this is from a fairly high level, but that's certainly an indicator that we're expecting continued weakness in farm incomes. Maybe surprisingly, slightly more lenders on balance told us that they expect farm household spending to decrease in the next quarter, which is I say surprising because even over the last year when incomes have been down and capital spending's been down, household spending's held up pretty well. So this is kind of an indicator that more lenders are expecting belts to start tightening among farm operations as the cash picture continues to deteriorate. And not surprisingly, a sizable majority also telling us that they expect capital spending by farm operations to decrease in the second quarter as well. Pretty stable outlook for loan demand, so positive on balance, but not really an uptick compared to the last quarter. You can see though a little bit more than 1/3 of lenders expecting an increase in loan demand in the second quarter of 2023 as we get into the sort of early stage of the growing season. Repayment rates fairly stable as well. Actually a larger share expecting them to increase, which is maybe one slight bit of positive news. But again, the vast majority not expecting any change in repayment rates, and renewals as well. Overwhelmingly stable outlook for renewal activity. So steady as she goes in terms of the financial and banking indicators, even though the income picture is down. And I'm going to kind of get right before I wrap up, give you sort of one little bit of positive news. We've heard a lot over the last 2 years about how the interest expense that farm operations pay for their existing debt, their operating and other loans, has become an increasing burden for farm operations. You can see certainly the level that interest rates are at as of the most recent quarter, much higher than they were 2 years ago, but they actually did take down slightly in the last quarter. Most categories just by about 20 basis points or 0.2%. The one exception, as you can see if you look closely on this chart here, was in variable rates or adjustable rate machinery loans. Actually did continue ticking to move upward just slightly in the last quarter, but all the other categories saw a slight downward movement. So it's cold comfort because the overall level of interest rates that farm operations are paying on these loans are still pretty elevated, certainly compared to what they've been used to over the last 20 years, but some slight easing in credit conditions for farm loans as well. And that's maybe good news if you're looking at the fact that we've seen growth in loan demand and expectations for higher loan demand going forward. And before I close it out, just give you a kind of quick look at land values. So this is another one that we would expect these lenders to have a really good insight on what the values of good farmland are in their areas. So this is just showing you irrigated farmland for those who are interested. You can check the release on our website. We also provide non-irrigated and ranch and pasture land values as well. Across the district overall, just under 4% increase in non-irrigated farmland values across the district. Quite a bit of variability. I don't want you to read too much into the Montana number of 25% increase in land values on a year-over-year basis. That was a very small sample that responded in both periods. So kind of heavily weighted by sort of basically one lender that saw a really big increase in their area. I would encourage you to kind of focus more on that headline number across the district. You can see in Minnesota, we get a lot of respondents from Minnesota, slightly lower rate of growth in land values in Minnesota, and then 9% in North Dakota, 4% in South Dakota. Wisconsin as well, we have kind of a smaller number of survey respondents from our portion of Wisconsin, so don't read too much into that number. Overall, land values up, but at a slower pace than they've been increasing, and this is in year-over-year terms. Once again, not in quarterly values. Likewise, we've seen some increase generally in cash rents on farmland, on non-irrigated farmland across the district. Just a 1% increase in cash rents. Those cash rental rates are pretty elevated relative to their levels of a few years ago, though. But 1% growth across our district on a year-over-year basis. You can see faster growth in North Dakota, actually a slight reduction in the cash rental rate on average in Minnesota, down just under 1% on a year-over-year basis. So not surprisingly, given the movement in land values, rents are up as well. But given the value of production that can be squeezed out of an acre, some slower growth in cash rents on land values. That's sort of consistent with what expectations are for earnings on an acre of land. So that's sort of the picture. Incomes, it's I don't want to sugarcoat it. It was a relatively negative quarter for survey results. That's consistent with what we've been hearing anecdotally from farmers and what we know about market conditions in the sector. But we'll see as how things shake out as we get through the growing season. A lot obviously depends on weather. A lot depends on international market conditions that are sort of beyond anyone's control. So a lot can happen, a lot can change over the next few months, but that's where we are heading into the growing season. Negative picture for incomes and expectations for more of the same headed forward. And with that, I've got a few minutes left before we're going to conclude here and would love to take some audience questions.
Yeah, and just as a reminder, if you have questions, please type them in the chat box on Zoom. So let's start with this one. Someone was wondering, it seems like the results were pretty negative for this quarter. Were there any bright spots?
Yeah, I should have mentioned that actually. The one big bright spot that I can point to is for cattle producers, for ranchers. And we got some surveys, some responses, some comments on the survey. Again, you can read a couple examples of those if you want to take a look at the write-up online. But we did have a lender, I believe it was in North Dakota, say cattle producers are happy, wheat farmers are not, which was kind of a sort of a quick way of summarizing the state of things right now. And that's, again, just due to market conditions. Cattle prices have held up pretty well. In fact, they're still up on a year-over-year basis compared to most of the other commodities, which are flat to down. And lower grain prices, lower corn prices is good news for cattle producers because corn's an input to cattle. So that means they're paying less for their feed costs. And that's actually been a benefit to their margins. And so the cattle picture is relatively good. And that's consistent with, I don't like to break out the state by state results too much or to dwell on those just because of the relatively small sample sizes. But if you look at some of the results, certainly on an individual basis from Montana, from the Western Dakotas, where cattle ranching is a heavier part of the industry, you can see they're a little stronger there.
Yeah, sure.
So that's the one bright spot I would point to.
Great. Someone else was also wondering, they said the survey results indicated land prices increased in the district. Is it unusual that they're still going up given higher interest rates and falling farm incomes?
Yeah, that's a good one. So this is a good opportunity to clarify that these are year-over-year changes in the land values. And a lot of the year-over-year difference in land values that's reflected in these was already baked in the cake earlier in the last year. So when I did this, when I did these survey results a year ago, the increase in land values was a lot higher. They continued increasing at a higher pace over subsequent quarters. So a lot of this year-over-year change had already happened prior to the last quarter, and it's just sort of a figment of the fact that we're looking at we're looking at it on a year-over-year basis in the last quarter. There was on net a slight increase in land values in the quarter. So I don't want you to walk away thinking that land values fell over the quarter, but it was small, certainly compared to what we've seen. And most of this increase had already happened prior to the first quarter of this year.
Yeah. And very closely related, someone else was also wondering, do you anticipate land values to increase, decrease, or stay the same in the next 1 to 3 years in Minnesota?
Oh, that's a really good question. And I don't necessarily want to weigh in on that just because I would just be a wild guess on my part. So much depends on market conditions. I mean, what we've seen over time, and you can look at land values over time, they go up a lot during periods where income is strong. So if we're expecting income to be down this year, I would expect not much growth in land values. That's not surprising, but nobody knows what's going to happen to farm incomes, even really this year, let alone 2-3 years from now. It's kind of impossible to say. So much of it depends on really fundamentals on what can be produced. And then, of course, interest rates as well are going to have some influence on that. But overwhelmingly, it's really a product of what can be produced on an acre of land, and that's anybody's guess.
For sure. And you touched a bit on crops and cattle earlier, but someone was wondering if you know anything about the hog industry picture.
Yeah, so the hog industry picture is not as good. They've benefited from the lower feed prices, the lower input costs, but the hog prices are not as strong. They've been decreasing on a year-over-year basis if you look at that sector, and that's consistent. And again, I don't even like getting into a lot of state level details, let alone sub-state level details. But if you look at southern Minnesota, where that's sort of one of the centers of hog production for the world. The results from there, I would just loosely characterize as being a little bit weaker, just because those the market prices are relatively weak. Yeah, that's what I'd say about that.
Great. And I don't see any other questions coming in right now, so that'll be our last question for today. I just want to say thank you so much to everyone for joining us. More information will be in our follow-up email to this event. And please join us for our next virtual event, Regional Economic Conditions Construction Sector Outlook, on Tuesday, May 21st at 9 a.m. Central Time. And with that, I hope everyone has a great day.
Thank you.